Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we're connecting you to the world of venture capital and private equity investing. And today in the hot seat is Nick Adams from Differential VC. Nick, welcome to the show.
Thanks, Matt. Great to be here.
Privilege is all mine, man. So you guys are doing some cool things. Very excited to connect you to my audience. So for our audience around the world, Nick, that hasn't heard about Differential and all the cool things that you guys are doing as a team, why don't you give us the elevator pitch about Differential VC and maybe just color in the picture for us on how you got your start in the world of venture capital?
Yeah, gladly. So Differential is a New York-based seed fund focused on AI machine learning, and we have been since back in 2017 when we started with our first fund. And really, that came from a combination of my background and my partner David's background, having spent. David spent 22 years at Renaissance Technologies using data science, machine learning, natural language processing to build the most successful quantitative hedge fund of all time. And I spent about 15 years in the enterprise tech world building enterprise solutions with big data, machine learning, natural language processing underneath of it. But the reality of the matter was in the 90s and the 2000s and early 2010s, machine learning and AI was really a lot of Band-Aid and bubble gum in the background. So as computing power in the cloud was becoming more prominent, we started a fund that was really focused on being able to process data and maximize the value of the crazy amount of data that's being created each day in the world. So that's what we've been doing for the last 5 years.
And what sort of check size do you cut, and who are you looking to back?
Yeah, so we come in pre-seed and seed, usually the first institutional money into a company. We write checks, the pre-seed as low as $250K. When we're leading a seed round, usually 1.5 to 2 million in most cases. Everything we do is B2B focused. We're not consumer investors, just not our specialty. And we're looking for anything up and down the AI machine learning tech stack. So we've broken our investment focus into 4 themes. They range from applied AI solutions down to the machine learning operations stack to the evolution of engineering and infrastructure. And then we do what we call responsible information handling and management, which is really cybersecurity and data privacy at this point.
So what makes you guys different or unique? What would you want the world to know? Because obviously you're doing some interesting things around, it's an AI fund, so I'm assuming it's got something to do with that. So what makes you guys different?
Yeah, I mean, David and I have both lived this world as practitioners and investors prior to moving into the world of venture capital. So it's funny, when I started this fund 5 years ago with David as my partner, I recognize that I'm product manager level technical. I know how to ask the right questions on technology, but I can get fooled by the right people. And where my experience is more around building business cases and figuring out how to go from that, I'm loath to use Peter Thiel's term 0 to 1, but go from 0 to 1 in a startup with a data oriented company. And David can sniff out, not scalable data science or machine learning technologies very quickly. So it has helped us be a very well-rounded team, both in terms of how we diligence and support companies in and around this really complex area. And we did this 5 years ago. Everybody thought it was brilliant, smartest guy on earth, so much to do with machine learning and AI, the right team to do it. And there's like 2 years of everybody was investing in crypto and metaverse, and I was a fool. Couldn't be dumber. Like, everything in AI has been done. Why aren't you in crypto? And then in like the last 4 months since ChatGPT came out and just like took the world by storm, I think my IQ's gone about 10 points again. I don't know what happened. It's a funny thing in this world.
Well, you're not wrong, man. I mean, I think we were like, oh, AI is coming one day, and then it was here, and then it didn't suck. And it was like, oh shit.
All right.
But
yeah.
But it's interesting. I've had this. Well, I want to double click on what you mean by an AI fund. Do you mean like it's an AI? Is it a fund for AI companies? Is it a fund that uses AI to evaluate issuers and potential opportunities? Like, unpack that for us.
Yeah, good distinction. As of today, we are predominantly investing in AI technologies. So that's our focus. We think there's an awful lot that can be done in that world where I think machine learning technology has succeeded so far is in building kind of a testing, groundwork, framework for seeing what can be done, but building really, scalable, bulletproof AI solutions from top to bottom is still pretty early days. So that's where we focus our time today. That said, I have, my partner is somebody who's really succeeded with actual, quantitative investing at the hedge fund level. Renaissance, if you're not familiar with them, returned like 45% a year for about 15 straight years. Just had an amazing run, truly trusting the math behind what they built. David and I, as much as we love AI and machine learning, we're very much skeptics about the possibilities and are very aware of the limitations of AI. His line is always, everybody calls it AI until it works, and then it's just an algorithm. And for us as a fund, truthfully, we are absolutely investing in becoming more data driven in our operations. I'm loath to say quantitative. I'm loath to say AI driven, but we are absolutely what I would say still in the early days of collecting, cleaning, trying to normalize data and seeing what's in there to figure out where in the process of a venture capital fund we could best plug in some more data driven functions and processes.
We were talking before we went live about SVB and all the shit show that went out around that story lately, and then before SVB, it was all around the economy, and I did probably like 170 interviews with founders all about raising money in the current markets and blah blah blah, and the prevailing kind of sentiment was that it's just generally uncertain. Then zombie VCs became a thing. Like someone labeled it was like these funds that are not actually cutting checks because of the economy, quote unquote. So from your perspective, though, Nick, do you give a shit about the macroeconomics at any point in time, or are you kind of like, look, I've got a fiduciary responsibility to my LPs, and I have to issue these checks. And as long as the fundamentals in these businesses are good enough, they should be good enough to prevail any kind of systemic threat to, pandemics or whatever the case might be. So where do you fall in this whole idea of the macroeconomics and your, and its ability to influence your decision making or not?
I view it as a bit of a blend, and I say that realizing I'm hedging. Part of any sound investment strategy, whether you're talking about private markets and doing the crazy shit we do in venture capital, or public markets, and taking advantage of things like the liquidity available in the stock market, or you mentioned SVB, thinking about hedging your interest rate exposure is just a good fundamental practice is to diversify over time. It's an easy thing you can do. And if you get on a regular cadence of investing in companies or in stocks or in treasuries or whatever it is you're into, you will at least get that diversification of time. We don't know exactly where the bottom will be. And I will say this, as a seed investor, the reality is if we are 20% wrong or even 30% wrong on the price we pay with our first check-in, it sucks. But if the company exits for $1 billion and we got in at 12 million instead of 10, we're going to be okay. Our friends in the later stages of venture capital that are coming in, Series B, Series C, and beyond, if you're 20 or 30% wrong on those investments, you've screwed up your entire, investment and, potentially your entire portfolio if you've concentrated your investments in too narrow of a period of time. So I see these funds who deployed, entire funds during end of 2020, early 2021, even late 2021. Like you're at the top of the cycle. So we try to deploy over usually a 3-year schedule and can even drag it out to 4. But we're absolutely still looking for innovative companies that we're looking 5-10 years down the line with how early we invest. So yeah, we're still writing checks.
Mm-hmm. And when it comes to your limited partners, how do they consider risks versus, as you mentioned, diversification when making investments into a fund like yours when the economy is doing what it's doing?
The good and bad thing about venture capital is that it is a very long holding period and it's extraordinarily illiquid. And I can tell you, we were closing Fund 2 at the end of 2022. And there were definitely some people who were getting a little jumpy about the market and were saying, I'm pulling back. I'm not going to make new investments right now. So that was fine. I just want a little bit more liquidity. And we had others who popped up and in, one 30-minute call, we got a, pretty substantial 7-figure commitment, right at the end of the year, because they were basically saying, we don't like what we're seeing in pretty much any other area of the market. Happy to tie up some cash here longer term. And, we can wait 10, 12 years for what we hope will be, a 3+X return on money, as opposed to trying to figure out where to put money in treasuries or the stock market or real estate or anywhere else at this point.
Got you. So, Nick, when it comes to actually making or cutting the check, what factors do you look for? I mean, obviously there's some fundamentals like great team, TAM, all that kind of stuff. But from your perspective, are they kind of key things they must have?
There are, for sure. So, I mean, I'm probably not the most popular investor for saying this. When you think about, product, team and market of what's most important, obviously all three are extremely important. But, from my perspective, the macroeconomics just have to be there. You could invest in Steve Jobs and if it was the wrong market, it's just not going to make it. And certainly things can change over time. I mean, we have a company in the AI space that was, always had amazing technology. We love their vision, but without the right use case and awareness in the broader market, we're kind of struggling. Overnight, with the ridiculous ascension of ChatGPT, these guys built a wait list of 30,000 people. I say overnight a little bit facetiously. It's over 2 weeks or 3 weeks, but really fast. So the macroeconomics have to be there. Of course, sometimes with the right founders and sector, you can back into that over time, but generally speaking, it's got to be there, right? And then, for us, I think the other layer is, obviously product is key, but really understanding data science and machine learning is critical for us. As seed investors, it's really easy to get crammed down in later rounds of funding, just because you can't write a big enough check to maintain your ownership when NEA or Excel or somebody else comes in and wants to take an entire Series A or Series B. Like, dilution is inevitable. So for us, I think because we have a resource like David, we hedge a lot of the early stage technology risk that I think a lot of funds do take, because we've just been in the trenches and built these types of solutions from the ground up. So why I give that long-winded answer is that the products that we invest in need to have one of two things. Either the value that's derived from them is from the genius of the AI or the algorithms or the founder's PhD or their work history, something along those lines, which isn't that common. Honestly, it's hard to do. These kids coming out of Stanford or MIT, Andreessen probably knows them when they're in diapers and is ready to seed fund them, or they're coming out of Google or Facebook or a bigger shop now. Or the other thing is they have to have just really sound understanding of data science, engineering principles, scalability, and the ability to add economic value to whatever problem they're solving. And in those situations, if they can do all that and then add value on a transaction by transaction basis and collect a really valuable, interesting data set alongside of the work they're doing and they're performing for their clients, that's kind of the holy grail for us.
Very cool. So you see a lot of deal flow, I'm sure, in any given point in time. Where does it go wrong for you? If you think about the last 100 pitches that you saw, what would you say is a commonality or key things that go wrong when a founder comes to you and asks for capital?
It's a really funny thing. I think a lot of founders just don't remember to get to the point in the first 5 slides or 45 seconds of their pitch. I can't tell you how many times I've been hunched over a deck at 7:30 in the morning, getting caught up from a weekend of deal flow, getting ready for our Monday afternoon deal flow meeting, reviewing decks. And realistically, for some of the stuff that comes in cold, if you're a founder, you have to realize you're probably getting 45 to 90 seconds of time of an associate or a partner at a fund to get your point across with your pitch deck and email. And I see these like long, MBA style presentations about market dynamics and stuff, which is all cool. But like it doesn't get to the point. And sometimes I'm glazing over, like thinking about my next cup of coffee, and all of a sudden I'll see this insane team on slide 27 of 38 in this pitch deck, or all of a sudden it's like, oh, by the way, we have 800K in recurring revenue, and here's what we learned about our customers, our early customers that churned, and why they weren't the right fit, and these are the right fit. It's like, holy shit! I'd have to go back and read the whole thing again. I feel like I had my sour grapes, my negative lens on reading through this deck, and I have to recalibrate. I think, for me, I love seeing pitch decks and pitches that just say like, what are you doing? Why is it important? Why are you really, qualified to solve this problem? And then what proof points do you have? If you're pre-product, pre-revenue, trying to raise angel funding or pre-seed funding, tell me about your team. Tell me about your work experience. Tell me about the conversations you have with potential customers. If it's traction, you're going for, seed or late seed or A, like show me where you are. What have you built? What have you learned? Why have customers churned and all that fun stuff. So just get to the point. Don't bury stuff. Don't bury the good stuff.
Keep it simple.
Keep it simple.
It's amazing. It was like to drink our own Kool-Aid. You know what I mean? It's like, let me kill you with information. It's like, no, dude. Like, I don't care. The shit that's in your business strategy is like, that's for you, not for me. I don't care.
Right. Yeah, I already paid for an expensive MBA. I don't want to do it again.
Yeah. Exactly. An MBA didn't really use. Told my parents I'd do it, but whatever.
For sure. It's a different time and place in my life.
I know, right? God, if we could only go back in time, eh?
Yeah.
Well, look, when you think about all the checks you've cut, Nick, obviously you're in Fund 2. So Fund 1 would have done well at some point. So what would you say, if you think about your greatest success in Fund 1 or 2 and your greatest failure, what made the difference?
I would say on the positive side, just the teams and or solo founder, when you have every now and then you find these absolute superstars, but generally a team that has a really solid combination of just technical skills and business savvy. They just perform better. Technology is not everything, right? I mean, we've seen it 100 times over, 1,000 times over in the market where the best product, the best technology does not always win. Sometimes they just get their ass kicked in the market. That's just a reality, right? Somebody markets better, somebody goes faster, whatever. But the combination of those two things, when you can get it, just right at the early stage, is pretty awesome to see. So that's where we've obviously had the best luck. I think it's what everybody's sort of searching for. But I think we really over-index on trying to find that right balance at the seed stage. And look, there are always co-founder challenges and delays in going to market, and the way we invest. We have kind of the applied AI solutions, which have the inverted issue from the deeper tech solutions we invest in. And applied AI, we kind of know who we're selling to, what the value prop is, how to go, who we're reaching out to. And it's just a matter of how far will that first product take you? Is it $500,000? Is it 5 million? Is it 500 million? And, from there, what other products we need to build to scale this into an IPO type company, right? For the deep tech companies, like, the world can be their oyster, but they probably have a lot of building to get there. And there's an awful lot of just, what's the right technical environment? What's the right sector? What's the right, geography? Like, just, you have so much qualifying to do in the early days to figure out who the right clients, early adopters will be. So you can build this niche and just pull on that thread to get you to a certain point. But that kind of the potential is already there. The world's your oyster. So I think when we get that right, we're good. Where we make mistakes, and try very hard to avoid this, because I did this in my own career as an operator, is when, I'll speak for myself, when I overvalue myself and what I could bring to a startup. In reality, sometimes you see a company, you just kind of fall in love with it. And I'm not I'm a washed up entrepreneur. I'm a washed up operator. I don't want to do it again. But every time you see something, you're like, yeah, I get this. I could make a difference here through the network, through, how we run the business and so forth. I find whenever I do that, like, I throw the brakes on. I go to my team, I go to my partner, and I'm like, hey, like, what do we? I need to de-bias myself here. Like, what do we really think about this opportunity and the team? And that's where I probably made my biggest mistakes as an operator and an investor.
So, what's your advice to a founder looking to raise capital from a VC today?
Look, it depends on the stage. It depends on your situation. I'll focus on seed and kind of first rounds of funding, obviously, because that's where we specialize and what I get. There's still plenty of money out there. The news cycle in venture and startups is so misleading in so many ways. Like, I hate that I'm becoming this person, but, like, it's hard to believe anything anymore, right? And especially in startups and technology and VCs, like, VCs talk a lot of shit, and I don't actually believe that they mean it all. I think they just say things to, sometimes distract from what they're actually doing, what they're actually investing in, how they're actually positioning their team. We're a pretty quiet fund. When we have something to say, it's usually pretty nerdy. It's usually, more around machine learning, AI, data science, and just kind of what we like. We're not out there to get on Twitter fights. So I just don't trust most of the news that comes out of, some of there's some great publications out there that I read and love, but I don't believe everybody's message. And to say that there's no money out there right now and deals aren't getting done is just categorically not true at the seed stage. There's plenty of money out there. It's not, the Wild West of 2021, which was, like, wildly unhealthy and unlike anything we've ever seen before anyway. But, like, everybody I know at the seed stage is looking to do deals. We're, like, dying to do deals. So I wouldn't hold back. Like, if this is what you want to do, go for it. What's good in some ways is a lot of the kind of opportunistic and I hate using this term, but tourist funding and investors at the seed stage have, a lot of them have moved out, more or less, aside from some of the bigger funds who still need to justify all the money they raise and are still coming a little bit earlier. But, like, a lot of family offices, angel investors, corporates that were doing seed deals a year ago or 18 months ago, they're not really in the market right now. So I would focus more on the seed funds, angel investors who are committed to investing in technology and have when you're going after, like, that angel round, that first $500,000 or $1 million of funding, like, go after the accelerators that focus on what you're passionate about. Go find people who are wildly successful in your industry that you're trying to tackle and change, and ask them, hit them up. Are they interested in being an advisor? Are they interested in writing a small check? There's plenty of that out there still today.
And Nick, we're going to take a quick break. Now we'll hear from one of our sponsors, and we'll be back in a moment. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Nick, I'm curious to understand from you, when it comes to capital structures, where do you fall with things like safe notes, convertible notes? Do you like to price the round? When do you choose one over the other? Walk us through your capital structure approach.
Strongly prefer to price around. We like leading as much as we can, but we also follow the right other lead investors that we have a comfort level with their diligence and just lead investor and board member capabilities. I really, well, whatever. I'm not going to hedge. I hate safes. I really don't like convertible notes. I hate them for our first investment into a company. I think they're pretty shitty instruments, despite the speed and the low cost of getting them done, which I get, I appreciate. I think they have their time and place, but they just became this generally accepted way of doing things, which, by the way, also a generally accepted way of doing things was to stuff all your money with SVB and not put it into a sweep account and make sure you're FDIC insured or have other accounts besides SVB. Right. These are kind of like standard operating procedures in the venture world and in the startup world that are pretty stupid. They just don't make sense. And, I've just seen so many safes go wrong for founders, for investors, for everybody involved. And, I think there's a big correction coming as prices come down. Somebody has to pay for that. And look, sometimes it's the earlier investors that get crammed down, because later investors don't really care if you're happy or not. And a lot of times, if you don't have the right investors around the table or board members, sometimes it's the founders. They just take on so much dilution by not understanding how much exposure they have to these convertible instruments and how much more dilution they'll take when they convert into a price round, especially when you start not hitting the cap on these things and you take the discount price. There's just a lot that goes into it. I think they're crappy instruments. I hope they go back into the corners where they belong, of like, first check, you have a bunch of angel investors or an incubator that's reasonable and not trying to take 25-30% of your company because they wrote the first check. And the other time when I think they're good for us or I'm more comfortable with them is when we're already invested in the company. We've kind of gone through the whole process of restructuring the docs, putting a board in place. There's just a little bit more, I think, control from our perspective to be able to put together a quick bridge round with a convertible note or a safe when we're already in the company and we know the proper governance is in place. And it sucks. The reality is, I mean, even as a lead seed investor over the last few years, I've had 5 scenarios where we've had to go back to the early investors or incubator labs and just had this, either like stacks and stacks of convertible instruments sitting on the cap table, or an incubator that took a huge chunk of the company, and basically you go back to them and you say, here's the reality of the situation. Nobody else is going to step up and price this deal and fund the company in the future. So your options are, come to the table and renegotiate the terms here on these convertible instruments, because they're not set in stone. They are renegotiable. Not come to the table. And, if we can't get anywhere on this, like, the company's probably going to die because nobody's ever going to fund it again, because just the incentive structure is not there for the founders. Or I can, sort of in a more aggressive way, try and recap this company that, could be really unfavorable for you. So, we've had to have those hard conversations in a few instances, and usually, people come around and want to negotiate and put the company on a healthier path. But it just sucks getting to that point at a seed stage company. It's just crazy instruments. That's a bit of a rant.
No, that's
these
cool.
things
That's
really
why I
do
do the
bother
show,
me.
dude. That's why I do the show, bro. You can rant however you want. It's interesting because the SAFE came out of YC, and then it was kind of like it was adopted faster than the bank run of SVP. Do you know what I mean? It was like, oh, you pre-revenue? Cool, you go SAFE. If you're revenue generating, we do a convertible note, maybe, depending on what the structure of the deal, whatever. And then, of course, there's the pricing of the round, and then but then how do you price it properly? Do you just, we don't do it, here's an auditing firm that's going to price you separately, and then you just negotiate from there, It's interesting to see different VCs using different instruments depending on context.
Yeah, like I said, there's time and place for all of them. It's hard to price $1 million round and or $500,000 round and pay $100,000 legal fees to get that done.
Not when your carry is 2%, dude. Like that shit adds up. I mean, you got to have a fund that's actually like 50 million or whatever,
Yeah, for sure.
So Nick, when an exit comes along, how do you prioritize and evaluate an exit opportunity?
Look, I think it's a function of what the what's the nature of the exit, right? There are largely comes down to where are the founders? How are they feeling? Are they up for another X number of years journey to keep building the company and try and get to the right outcome? It's an assessment of the macro conditions and just what's happening out in the world and what we're expecting in the time period that the company would be going public or being acquired. Then I think it's just venture capital and venture capital backed startups is very much a momentum business. And, it's like companies that don't have revenue sometimes get so much excitement and noise because it's easy to believe and be optimistic about what they could do when, and then this is another just sort of like, I think, sort of flaw in the market. In some cases is that if you took seed funding or Series A and you just didn't hit the growth rate and you didn't triple your revenue in a year, and you become sort of a little bit stale and less sexy investment in the VC community, momentum kills startups that otherwise have a good business and might just need a little bit more time. So I think it's sort of a word of caution to founders when they take VC money. If investors are happy with getting their money back, or a fraction of their money back, or a 2x, you're probably going to be shoehorned into going down that path. And conversely, if you're ready to get out and go home and whatever the equity is available to the founders is meaningfully life changing. But your investors aren't supportive of it, you're in it for the long haul. You got to buckle up and get your head back in the game and get ready to go keep building the company. And that's a very emotionally hard thing to do. So whenever it pops up, I kind of usually have, we've already done our assessment more or less what we think the company's prospects are and what the macro conditions are. And then it's like, where's the founder? And no matter what the scenario is, if we explore an M&A, these are long, volatile processes, and it's not done until the money is literally in the bank. And I think that's the thing that when we do go down the M&A path, sort of just from a founder psychology perspective, I'm like never. This is like I'm a washed up baseball player, so forgive me. It's like a baseball game. Like there's no end. There's no whistle to save you here. It's done when the money hits the bank account, and you got to stay ready to run the business until that happens. So, a lot of it comes down to what we think about the company and where the founders are just psychologically for building or not.
So, what keeps you up at night, Nick, when you think about venture capital? Is it the performance of your portfolio? Is it the carry? Is it the, what keeps you up at night?
I mean, I think a lot of VCs are afraid to say this. At the end of the day, we're fund managers, and my number one financial responsibility is to our LPs, our investors, and sometimes we have to do things that are in the best interest of our investors. I think doing that in a respectful and productive way is key. But I think pushing for an M&A early when you just don't think a company has the juice, or the founders just don't have the wherewithal to take the company through to an IPO or a bigger exit, or you think the competition's coming fast. You just have to have those hard conversations. It's not personal; it's business. If you can deliver that with respect and still appreciation for what founders are attempting to do, then everybody can get what they need. So yeah, and first and foremost is just getting the exits to return capital to our investors, and sometimes that means pushing for M&A. Sometimes that means making changes in the leadership team. Sometimes that means exploring secondary opportunities when you're at the peak of a market. It's something that we've done. It's something that a lot of VCs did in the last 3 or 4 years, and nobody likes to talk about it. But there were a ton of secondaries for not just investors, but also founders. Took a lot of money off the table, more so than ever before, and at earlier stages than ever before. And sort of this, I don't know, everybody wants to still keep talking, we're like tripping over each other to be more founder friendly than the other investor. It's like, we're in a business together, and we each have to do what's best for us, and hopefully in a way that supports the company in a healthy way. But everybody's in a business. So I feel like some of these things just get lost. So yeah, it's my number one thing. I think, then it's just, I will say this, every single founder that we back, like you root for them, not just for our own returns, but for their success. I stress this to every single founder. We have a portfolio now of 27 companies, right, across 2 funds, but fund 1 was 16, fund 2, we have 11 investments so far. We'll have another 10 or so in the next year and a half or two. If one company doesn't make it, we direct our attention to other places, and that's just the reality of the business. If you're a founder, we can do everything we can to try and help, but at some point, we have to focus on what's going to return our fund. And founders have a portfolio of 1, and I truly want it for each and every single one of them. And one of my founders in Toronto said to me very astutely, he said, startups don't fail, founders quit at some point, and it's true. And that could come, it depends on your pain tolerance as a human being and financially, and I think every founder needs to figure out what their floor is in terms of risk, and what's acceptable. If you have family and kids and things like that, you can't go starving. But if you're single and young and whatever else, and can take the risk of waking up on your mom's couch, then maybe you go for it. And that's just the reality of the market and of risk management in your own profession and personal lives. So I want it for every single founder. It keeps me up. I can only do so much. Our team can only do so much, but you do want it for every single one of them.
Yeah, I tweeted that, by the way. Startups don't fail. Founders quit.
Nice.
I wish someone had told me that when I was 26, because
yeah,
I would be a lot richer today, I think.
Nice.
Nick, when you think about the next 10 years of venture capital, how do you see it evolving, and what do you think its impact will be on founders?
I think we'll have a few things that I'm going to be optimistic here. I think a few things will happen. I think venture capital will become increasingly specialized. I think there's just too many sources of capital now for early stage generalist funds, unless you really have an army of people running around trying to do deals. So I do think, like I said, we don't invest in consumer stuff. We've been pulled into you know, sometimes the business model of a pre-revenue company evolves, and we've been sort of pulled into a consumer first business model, which is different. But in terms of picking the next hot consumer product, it's never going to be us. We would need to hire a whole other team. If one day we decide it makes sense to raise a growth fund, David and I will still manage the overall business, but we need investment bankers, people with deep experience investing in later stage companies that would run that side of things for us. Like, we get it from a fund management perspective, but from winning those deals and pricing them appropriately and everything else, we bring in experts to do that. They're smarter than us. So I do think we'll see increasing levels of specialization in venture. The huge funds, God bless them, I don't know how they're going to return these massive early stage funds, but they'll figure something out, I guess. I think they will, struggle. Would be the only ones that kind of continue to have multiple assets, geographies, et cetera, and stages under their umbrella for foreseeable future. And for startups themselves, I do still think there's no better time to start a new company. Just there's so much happening every day. There's so much opportunity, and there are so many different types of capital available for founders to get up and running and make that decision. Do I want to go try and, if you put yourself in position to raise venture capital funding or not and take a different path, you're in a really powerful spot. I mean, I have so many people that want to come to us and pitch us, and like, this is a great company, it's a great business. I just don't think it's venture backable. And people get very defensive about that. And like, if you can run your own business and put yourself in a position to own 75 to 100% of a company when it exits without me on your back as a board member and investor all the time, like trying to figure out how to make you $1 billion company, why wouldn't you do that? I have some friends, former colleagues of mine in tech world, that get this very well. Like, bootstrap, raise funding from friends, family, angel investors, but figure out how to get profitable as fast as possible, so that if you sell the company for $20 million and you own 100% of it, or if you own 75% of it, it's a really meaningful, life-changing outcome for a lot of people. Like, give yourself the flexibility and optionality to get to that point. And I think we will increasingly see more of that thinking and mindset in founders as entrepreneurship has become more and more of a career and a lifestyle for more people. I think we'll see more decisions along those lines of like, hey, maybe I take VC funding and specialize and then get to a certain growth phase where we take the huge money, or maybe we just find a way to piece money together and keep growing at a slower pace and take the outcome of our choosing.
Mm-hmm. Nick, if you could get into a time machine, go back to yourself on day one, like no fund, no LPs, no nothing, but you wanted to get into the space, what advice would you give yourself, knowing now what you know about the world of venture capital and investing?
I wouldn't change that much, to be honest with you. I think, we're all, I think I was naive about fundraising at that point. You think about going out and raising $25 million, $30 million fund one, and like, yeah, I can see where that will come from. I've got a little bit of money, and so and so will give me a little bit of money, and if we can just get into this, fund of funds who backs first time funds, and I think I was probably naive on that side of things. In reality, and I've had an LP say this to me before. He's like, you weren't rich enough to start a fund. He's like, you did pretty well, but like, you weren't, like, you need to be rich to start your own fund like this. I said, well, I'm a washed up athlete I didn't grow with much money, and I grew up, in kind of like the self-Boston community. Like, it's kind of like, well, fuck you, I'll figure it out. And it's not as easy as it sounds. Like in hindsight, it was a pretty overly confident and naive, fuck you, I'll figure it out. But fortunately, it worked out. But fundraising's hard. Just getting in there and meeting the right people and not coming out of a tier 1 fund previously. Those are all real limiting factors to raising your first fund without serious long-term standing connections to capital. Other than that, I don't think that much has surprised me. Other than I think in fund 1, I was a little surprised at how many rounds we ended up leading, just because my mindset coming out in New York, I wanted to be. My primary goal is to be a really good value-adding partner to bigger funds when they're doing AI, machine learning oriented investments, because I felt like we could be useful and prove our worth on the cap table. That was fine. That worked out really well for us in a few instances. We were in data band alongside Bloomberg Capital and Bessemer and Larry Hippo. We got really good outcome there when IBM picked them up. But what I found with other seed funds that were newer was that there was just kind of a lack of quality of thought and diligence that I just wasn't really comfortable with, following other investors without like really digging in. And there were a handful of times where we dug in into a company and, we found things ranging from, sloppy work to outright fraud. And, it was a scary moment. Those are scary things. And it shocked me because my mindset was always like, who the hell is Differential Ventures? Why is Bloomberg going to care about us? Why is Bessemer going to care about us? So we better, when we show them a deal or come to the table, like we better be really freaking ready to go. So we probably overinvested in our diligence and how we documented our work early on to like prove our worth at the table. So when I saw other seed funds just be like, I know, yeah, it's cool. We like the founder. We wrote them a check on a safe and we'll see what happens. I was like, holy shit, we have a problem here. So I think those are my two things: fundraising and just like, a little extra diligence goes a long way. And over-investing in some of that stuff that's really not the sexy part of venture capital is really important to building a business in this world, I think.
Cool, man. Look, Nick, thank you. That concludes your time in the hot seat. Thanks for sharing your perspectives on the Private Placement Perspective series. Thanks for being here, bud. Just stick around and say goodbye to everybody, but we'll speak to you all again soon.